My guest today, Dror Poleg, graduate, talks about the impact of crowdfunding on the private equity space and how technology is changing real estate. Dror has developed over 30 million square feet of commercial real estate and is one of the foremost thought leaders in the industry today. Welcome to the National Real Estate Forum podcast, episode 226. Thank you for joining me today. I am Dr. Adam Gower and this is the nationalrealestateforum.org, where I speak to leaders of the crowdfund real estate industry so that you can learn how to raise capital, build wealth, and earn passive income from crowdfund real estate deals. A great way to mitigate risk in real estate is to invest in the macro trends of the market. In other words, buy as the economy goes from recession to boom and then mitigate risk in real estate is to invest in the macro trends of the market. In other words, buy as the economy goes from recession to boom and then get out before it busts. Of course, while the first part is relatively easy, judging when to get out is a lot harder. In fact, it takes courage to get out because that involves either selling everything or possibly even ceasing operations, i.e. shutting down your business. Who does that when all around continue developing and building and creating wealth? But sometimes it's not so difficult to see, and I'm going to go out on a limb here. Take, for example, the fix and flip industry. Here, residential real estate, unburdened as it is by income from tenants, he said, removing tongue from cheek, is bought, often cosmetically improved and then sold. All well and good when the market is climbing, but disastrous when the market turns. An earlier podcast guest of mine, Professor Charles Nathanson of Northwestern University, found that when fix and flippers dominate the single-family episode at the nationalrealestateforum.org website, nreforum.org/Dror, D-R-O-R. I mention this because two recent news headlines that I cover in the news digest that I produce that you can subscribe to at the forum website state as follows. One says, quote, soaring home prices forcing buyers to dig even deeper. Increasing numbers of borrowers are spending 45% of their paycheck on repayments, unquote. That's a staggeringly high percentage of income on housing. And the other notes that, quote, U.S. home flipping increased to 11-year high, unquote. What with the instability in Washington at the moment and trade and military wars looming, if you're a fix and flipper, it's time to sell up, stash your cash, and wait for the correction. Right, I shall pull my neck back in now and suggest that you subscribe to the news digest at the nationalrealestateforum.org website, nreforum.org, right below the podcast website, nreforum.org, right below the podcast player at the top of the page, to hear all the latest news and to make your own call about where we are in the cycle. My guest today, Dror Poleg, is one of the most accomplished real estate developers you'll come across. He is a highly sought-after advisor to institutional capital funds around the world for his insights and strategic thinking as to how tech meets and transforms the real estate industry. I've included links to his site, Rethinking Real Estate, at the show notes to today's episode at nreforum.org/Dror, which is spelled D-R-O-R.
Okay, so I spent the bulk of my career, a little over 10 years, in China, developing institutional real estate, about 30 million square feet of shopping mall space, offices, about 26,000 apartments, and some service apartments, together with a Dutch-Israeli fund. Some of these assets we sold to institutional investors. We were partners with BlackRock on one project. We sold some other projects to some private equity funds in Asia, to a REIT in Asia. So really experienced the whole real estate development process from beginning, buying land, developing a large project, leasing it or selling it, stabilizing it, and then bringing in a financial partner and really getting the asset all the way to being owned by an institutional investor, which means that it's like now a mature quality asset. I arrived into the real estate world from the world of online development and design, so digital design of all things. I was partner in a digital design agency in Israel, which is where I'm originally from, and then in Australia, in China. And through helping real estate developers on some projects, I gradually got sucked into the business. So from the marketing side to the market research side to the presenting to investors and government to leading the leasing of commercial assets, and then finally to really just handling the big deals. So either acquiring land or negotiating sales of whole projects with large investors. And these days, I have a small consultancy based in New York City, advising large-scale real estate owners and operators and private equity firms on innovation in real estate. So anything from understanding long-term trends that are driven by technology, such as changes to the nature of work or how people get married, or education trends and autonomous vehicles, different things that impact the real estate industry. There's different technologies and tools and business models that they can implement today in order to produce more value out of their assets, up to really looking at the underwriting of specific deals that involve some innovative component, mostly co-working, flexible office, co-living, or anything along that spectrum. And on the other side of my business, I work with startups that are focused specifically on the real estate industry. So anything from modular construction, building management systems, different sensors and IoT, to kind of more communal ventures and operating systems for whole neighborhoods.
Well, it's really interesting, Dror. I didn't realize you did that. So where are your clients based typically, and where are your projects, do you find?
So I wouldn't say that there is a typical client. I've worked with clients in Japan, in Turkey, in the UK, here in New York, in the West Coast, in China. So really starting from very large owner-operators, companies like, let's say, British Land, which is a company with about 25 or 26 billion of assets under management, and some smaller real estate companies, but still usually about 5 billion assets under management and above, and some funds that are either based here in the U.S. or based out of Hong Kong, commonly.
Well, I'd love to talk to you about some of these technological innovations that you're specializing on. So maybe we can revisit that another time. What I'd like to focus on for today's podcast is the private equity world, and to talk to you about, what exactly is private equity and how is it structured. So let's start with kind of the very highest level, the most open-ended question I could think of, and that is, what is private equity in real estate?
So private equity in real estate is basically using private money as opposed to public money in order to fund the equity or to acquire and operate real estate projects. I'm sure your listeners are familiar with REITs, REITs. REITs are public equity that basically allow retail investors to own a piece of a real estate portfolio. And private equity mostly refers to funds that are managed in order to acquire and generate as much value as possible out of usually large-scale real estate projects. And these funds are usually capitalized by institutional investors or high-net-worth individuals.
For the only news digest focused exclusively on the crowdfund real estate industry, please subscribe for free using the link on today's show notes page at the National Real Estate. Please subscribe for free using the link on today's show notes page at the National Real Estate Forum.org website, nreforum.org/Dror, DROR. Okay, so what do they look like exactly? When you say a fund, there's that famous expression, companies are people, right? So when you talk about a fund, what do you mean? Let's really kind of break it down for those who don't know what a private equity fund is. What does it actually look like on the inside?
So a fund like a venture capital fund, same as a private equity real estate fund, has the clearest division is between what is called the general partners, people that are actually actively managing the fund and its assets and are also partners in the fund. So sometimes they put in some of their own capital into it. And limited partners, which are people that bring money into the fund but do not have any managerial responsibilities in terms of their legal exposure, but of course liability in terms of being able to lose their money and having no control over or limited control over how the general partner is managing it.
Okay.
These limited partners are often institutional investors, people that have a lot of money to allocate, are not necessarily real estate specialists, so like a pension fund, an insurance company, a sovereign wealth fund, people that manage a lot of money and have huge portfolios that usually a very small percentage of them is allocated to real estate. And then the general partners, the people that manage the fund, are usually property professionals or private equity real estate professionals that have experience of actually running an asset.
Okay, so actually I'm quite interested in understanding, or at least I'm quite interested in describing exactly what this looks like if you were to walk into a private equity fund. So if you were to walk into a private equity fund, there would be, literally, if you were to walk through the door, you'd see how many people sitting there. And what is a typical day for them when they are trying to raise their fund, right, to get the capital that they need? How are they doing that? And when they walk into those institutions, what do those rooms look like? Literally, right? How many people are there? Is it one guy sitting at a desk who's got, $1 billion and he needs to allocate 100 million? How does it work actually at that level?
So it's an interesting question because it's a question that the answer to it, I think, is changing in line with technology these days. So I think most of these funds originally have relatively small teams. If they have several offices or focus on geographies, they might have a handful of people in each area. That would mean several general partners, which are really the ones managing the fund, then a few analysts, and sometimes, depending on the type of assets that they invest in, they would have additional people that have operational capabilities or specific expertise. Let's say if it's in shopping malls or in office leasing, people that can help when you do due diligence on an asset or when you oversee the people that are operating the actual asset, and you can kind of know when, things cost too much, or you can leverage relationships that you have from other assets in order to make that specific asset better. But part of what is changing now is that real estate as a whole is becoming much more operationally intensive. And if in the past the operators were almost like commodity people that have unique operational expertise as well, or unique relationships, and in some cases even unique technology.
But let's step back for a moment and tell me, what does it look like when that fund manager sits down and needs to raise his fund? How is he doing that? What's he doing, and who's he going to talk to? What kind of numbers are we typically talking about?
So first, I think it seems that the vast majority, or a lot of the time of the fund managers, is dedicated to raising funds. And some would even say that their main skill is the ability to raise funds, so more than actually picking the right investments. And definitely the traditional funds, the ones that are still leading the market today, their success is very much attributed to the relationships that they have and that they've built over the years with the investors, so their ability to raise capital. When they market today, their success is very much attributed to the relationships that they have and that they've built over the years with the investors, so their ability to raise capital. When they set up a new fund, they go and try to raise money for it. They usually have a target. They either rely on their direct relationships. They can rely on companies that are called placement agents, which are companies that assist limited partners, so institutional investors and high net worth individuals, to allocate their own capital into different funds. So these placement agents are another type of middleman. They're theoretically familiar with all the different funds around the world. There are other third-party companies that grade some of these funds, assuming that these funds have a track record. So when the institutional investors are looking for an investment, they're placement agents to assist funds that they're about to invest in.
Right. So the fund managers, the general managers, they go out. They'll go
general partners.
the general partners go to institutional or to institutions, and at the institutions there are individuals who are responsible for huge amounts of assets that they have to deploy,
Correct.
huge amounts of cash, and they've allocated a certain amount. So an institutional private equity fund will raise 50 or 100 million from any individual institution, and that will typically be based on the relationship probably with maybe just one guy at the institution that they have, right, whose job it is to allocate those funds. Now, at the institution, they're going to have investment committees and whatever else they
Correct.
have to authorize the divestments, the investments. But that's basically the process.
Sometimes the holding period.
And committees and whatever else they
Correct.
have to authorize the divestments, the investments. But that's basically the process, isn't it?
So relationships matter, but again, I wouldn't say it's definitely not one guy's decision. There are investment committees. These institutional investors, to begin with, have their own mandates and very strict criteria in terms of the risk profile, sometimes geography, sometimes type of assets, sometimes the holding period. So the fund has to fit all of these. Another thing to note is that institutional investors also vary in terms of the size of the team and level of expertise that they have. If you start at the top, you have some sovereign wealth funds like GIC from Singapore, or the Canadian pensions, which have very, very relatively large and very professional real estate. So they really have their own know-how and ability to evaluate funds. They also invest in assets directly because of their capabilities. And on the other hand, you might have, we can call it poorer institutional investors that manage a lot of money but have very small teams and very small budgets in terms of their own overhead. So I guess like something like the Illinois Pensions Management Board or institution, I'm not sure their full name is, which operate with a very small team and really rely completely almost on other people's opinions and feedback when they decide how to invest.
Okay, so now we have a fund that's gone out, it's raised its capital. It could be hundreds of millions of dollars, even billions of dollars, that they raise from a cadre of institutional investors, including high net worth and sovereign wealth funds. And now they've got this fund.
They make money because the second that they close the fund, basically once they're done raising the money, they're already starting to make money in theory. So the compensation models for these funds is along the lines of what is called 2 and 20. So they take a certain percentage, 2%, but these days probably less, 1.5 or 1% of the total funds raised per year as a management fee, and 20% or less these days of the carried interest, of basically the added value that they create to those assets. So 20% from the upside.
Okay, so that's very interesting. Now they've got their overhead covered with the 2, and they're motivated to increase the value. If you're managing $1 billion and you can make 20% of any profit on that money, then you start to motivated to increase the value. If you're managing $1 billion and you can make 20% of any profit on that money, then you're starting to talk about highly motivating figures. So what do they do on a day-to-day basis to find deals to invest in? What are they looking for?
So depending on the strategy of the fund, there are 4 main, I would say, strategies that private equity funds look at, starting from core investments, which are really the most stable, best quality assets, center of, main cities. Core plus, which are assets of the same kind, but that might have some very limited value add potential, such as leases that are lapsing, or renovations or certain little things that could improve them. Then complete value add, which are still relatively good and developed, but have some more major potential for value creation. So either the occupancy is quite low and there's room to to change things, or there's one tenant that has issues that could be replaced or needs some, specific type of negotiation skills that the existing owner can't handle, or several leases that are lapsing within the next year or two that the new buyer assumes that he could find better people for that will pay significantly more, or sometimes on the financial side, restructuring, refinancing of different kinds that can ultimately create higher return for the new equity. And the last category is opportunistic investment, which entails significant more risk. So anything from ground up development, taking distressed assets and repositioning them, basically doing things that are riskier.
Okay. The fund managers, they're not actually executing on these strategies themselves, are they? They're going out to find sponsors or operators. So tell me about what that is all about.
So they sometimes do it themselves, sometimes they cooperate with others. So they go and look for deals like the rest of us in some ways. I mean, they use brokers, all the large broker firms, like Cushman & Wakefield, Jones Lang LaSalle, CBRE, Savills, Colliers, have their own capital markets team or kind of investment brokerage and people that tend to these type of clients and try to find them opportunities. They also leverage their own relationships. So again, through their own network, looking at things that, looking for opportunities to invest in. Some funds also specialize in sourcing deals, and they have, unique sources, whether it's different types of foreclosures or other similar large investors that own certain things, but need to liquidate for certain reasons. They buy or sell from other funds that are focused on different strategies. So let's say there's one fund that has, as we said, an opportunistic strategy. It owned an asset that was under development, and once the asset is almost stabilized, it can sell the asset to another fund that has, let's say, a value add strategy and can take that asset from, 80% occupancy to 96% occupancy, at which stage it would sell it to a core plus fund or to a core fund that could just buy it as a stable asset for a much higher price and not bring much more value, but just enjoy the yield, which is what institutional investors ultimately want.
Right.
Usually they don't want to take a value that brings them 5% a year or 6% a year and not have to do anything to it and just be happy. But it's getting harder and harder to find assets like that, especially when you have so much more new money to allocate each year.
Okay, so I'm kind of drilling down on one particular aspect, and I'll get to the why in a moment, because ultimately we are, my focus, as you know, is on crowdfunding. So let's look at the model of the private equity fund that doesn't operate and develop itself, but that in fact goes out to look for operators and sponsors to invest in. So let's talk about that. What is that process about, and how does the private equity fund find the sponsors and then assess the deals and then manage the subsequent investment? And then assess the deals and then manage the subsequent investment.
So I can give you an example just from my own experience. So one of the projects we developed in China, a shopping mall, just after it opened, so it was still a new mall, not fully stable yet. I think around 80 or 85% leased. About 80% of the space that was leased was already open and operating. We received an investment from a fund that is owned by BlackRock, which is more known for managing other investment products, but they also have like a small, about $10 billion real estate private equity business. And they bought 50% of the holding company of our mall and became our partners. To do that, so they arrived to us through a broker, in that case, to a deal, looking both at the market at large and specifically at our project and everything we could tell them about it, including assessing us as managers, so spending a lot of time with us, challenging us on the rent roll and on each specific tenant that we have, Why did we give them these terms? Why not those terms? Our assumptions about the additional space that will be filled, etc. And once we became partners, they sat on the board, they had a seat on the board of the project. And in our operating agreement, which was signed when they invested, we also defined certain key decisions that they have a say about, or even a veto on. So we were operating the asset, but major decisions such as, major capital investments, changes to more than a certain percentage of the tenant mix, and other things had to be approved with them or by them.
Okay, so what were those other things? Let's just give me a handful of the other things that were important for them to either have a say in or veto right over.
I think the most contentious issues are things that are actually purely financial. For example, if we want to refinance the asset, if we want to sell a piece of our ownership, if what to do in case there's an opportunity to sell the whole project, what to do if they buy the whole project and we don't own it anymore, what are our responsibilities in terms of operating it and, ensuring that there's a successful and smooth transition. So mostly these type of things, which again are very common to any type of kind of successful and smooth transition. So mostly these type of things, which again are very common to any type of kind of merger or acquisition elsewhere.
What kind of triggers were there for this fund? Should the deal not perform the way that had been projected, for them to take control or to step in?
So in terms of not performing as has been projected, I think their ability was probably more limited than what is prevalent in the crowdfunding world. I mean, at the end of the day, they invested in an asset that they assumed that they're almost unable to operate without their partner. I mean, they can bring in a third party, but it's very hard for them to step in. So part of the assumption is that they're taking a big risk and that they trust you. And if they wouldn't,
fund that invests with an operator, right, with a sponsor, and there are all kinds of rights that they have and controls over certain key decisions. But in the event that the business plan is not going as planned, right, if the sponsor is not performing as originally anticipated, what kind of controls does the private equity fund typically have to step in and take over, if any?
So de facto, they can basically replace certain people in management. In an extreme situation, they can replace us completely as operators of the asset. So we can remain their partners in ownership until there's a new buyer, but we will have to cede the actual operation to another operator. There is a budget approval procedure. Each have to cede the actual operation to another operator. There is a budget approval procedure each year with quarterly reviews, which again, during that process, if they want to make life difficult for us in terms of how we spend money on this project, they can make it difficult for us.
Obviously some bad boy clauses, right?
Yes, but I mean, there's bad boy clauses, there's key man clauses, again, limiting what we can do if we want to, if we have some really talented person there that we want to then move to one of our other new projects, that's something that we can't do. There's all sorts of things. I think in China, mostly the bad boy was about indemnifying them in case we do certain things, in terms of bribing or doing something that is illegal locally or internationally. So again,
but in the States,
it's relatively similar. So I mean, basically, their goal is to be completely indemnified as much as possible for anything that you do, but on the other hand, to have as much power as they can get away with, in balance with the previous point.
Interesting. Okay, and so then trying to look at this in general terms, how are sponsors and operators typically compensated when it's coming from a private equity fund, when the equity is coming from a private equity fund? And what about their fees? How are those treated as well? How does the sponsor make money, and how does the private equity fund look? What kind of fees do private equity funds allow sponsors to have?
So it depends. In some cases, the sponsor could be a straight-up partner, so it could be a 50-50 partnership. And in that case, there's no waterfall, there's no promote. Basically, you both own the asset. If the asset does well, both of you make money. And in that case, it also means that probably the 50% that the private equity fund owns was sold to it by the sponsor who originally brought in the project. So assuming that the sponsor already made some money already on that piece of the deal, on that half, and that when they both sell in the end, they're going to make more money. Other structures have a promote, which is, I think, very similar to how it works in smaller deals. So the sponsor can get sometimes a small piece in the beginning just for bringing the deal. So something between 0.5% to 2%, which he's sometimes expected to actually reinvest or keep as part of the deal. So not necessarily to take it home. And then upon exit or other major financial events such as refinancing, there's a promote structure that means that once the returns for the private equity investors meet a certain hurdle, and that depends on the type of the asset, it could be 5%, 8%, 12%, 15%, then the rest of the returns are split between the two partners, whether it's 80-20, 70-30, 50-50, or even with a few different steps and a more complex waterfall.
Along the way, right. And then what kind of fees typically will sponsors be allowed to have by private equity funds?
It's hard for me to say, to cite a general rule. It really depends on the market. It depends on the type of asset. It depends on the timing. Like these days, some other times everyone needs cash, and those that bring it can dictate terms. So I can't cite any. I can't generalize on that.
I see. Interesting. All right. So to the extent that you have familiarity with crowdfunding, and obviously, Dror, your perspective is at the truly institutional levels, large numbers in terms of the kinds of investments, the kinds of deals. And crowdfunding certainly, as it stands today, is much more at the lower end of the dollar spectrum, if you like. But that said, there are still private equity funds that operate in the middle market range. What is the impact, do you think, of crowdfunding on the private equity space? What do you think that impact is? And
suddenly everyone can know
funding on the private equity space. What do you think that impact is? And it's the impact of technology, really, isn't it?
It is in many ways. So I see several ways in which crowdfunding impacts private equity, both directly and indirectly. First and foremost, technology means that access to information is being democratized. So suddenly everyone can know almost anything, both about investment opportunities, the investment details of specific opportunities, and also they can know a lot about the market. Like today, definitely in developed markets, in a place like New York City, almost every building that you look at, you can find online, how it is performing, who are the tenants, who bought it before, who bought it later, if there are any violations or complaints. You have access to rich information so technology does that, and crowdfunding contributes to that and benefits from that. Second, it democratizes access to capital, which means that developers or sponsors today that have a good deal or a track record, they can go directly to people with money and raise money from them instead of relying on private equity funds or larger investors. They can pull together resources. from smaller investors and still get larger and larger projects done as is happening. Which means that to an extent it poses an alternative to private equity funds. Not a significant one yet, but a growing one. It empowers, in a way, the flight of talent from big funds and big developers. So if in the past I was working for a private equity fund and I was doing really well, I could maybe go and find a job with a similar fund. But today, there's actually an alternative for me to say, hey, I'm actually really good at finding those deals. I have relationships with developers, maybe even with the government. I know the market better than anyone. Why don't I just go and syndicate myself and, put myself out there and raise money through crowdfunding? So it's incentivizing executives to go at it alone. Again, I think still in a limited way. But it also does things that in some way I think benefits the larger private equity real estate funds.
Oh, that's interesting. How so?
So in a way, as you said, currently crowdfunding is mostly focused at the lower end or the lower parts. And in a sense, it makes the market much more fragmented than it was because it empowers a lot of small players, which means that those funds that are really, really large and usually have unique operational capabilities as well are only getting bigger. And it's harder for medium-sized funds or for medium-sized operators to compete with them or gain leverage when facing them. If we need an example, we can start with the retail world because there the dependence on the operator is most obvious. You can have companies like Simon or Westfield, which have very unique operational capabilities. They have proprietary brands, they have proprietary technology, they have proprietary relationships with tenants, and they have their own fund management business, so they can raise money. And they leverage their network and their scale to benefit all the different assets that they own. To the extent that if someone just buys one shopping mall, it would be very hard for them to compete with these guys in terms of their leasing capabilities, marketing capabilities, asset management technologies, etc. And when the middle and bottom of the market is getting more fragmented, it means it's harder and harder for people to climb out of that space and compete with those really, really large operators or fund managers. Another example is Blackstone. So these guys manage more than 100 billion of different real estate assets. Most of it is office. And they're today investing in almost like startups, in companies that specialize in operating office space and in technologies that optimize the way energy is used and the way space is marketed, etc. And unless you're very, very large, it's hard for you as an owner of one asset or 5 assets or even 20 assets to compete with them. And it's going to get harder and harder.
That's really interesting insight, Dror. Okay, so let me pivot with the few minutes that we have left. Let me pivot. I have to ask you, even though we should probably do another podcast conversation about it. But,
sure.
Tell me what you're seeing in the way of technology impacting the real estate space. Like, what would you say are the two biggest shifts in technology that are going to make the biggest impact on the way the real estate industry performs over the next few years?
I think that technology at large, I don't see one technology, but different technologies together are creating dramatic changes to the real estate industry. So starting from the way they impact the way people work, the way people raise their families, the way people move or don't move, the stability of jobs in general, the fact that even people that are doing well and, are educated and experts don't have 20 or 30-year careers with the same company, which means that they're less likely to stay in the same place, less likely to take a mortgage, sometimes less likely to even want to own anything. So technology is impacting real estate this way, which is indirect, but it's very significant. And then more directly, technology is basically redefining all the basic tenets of real estate value, starting from the meaning of location and the value of location, then the meaning of visibility and accessibility, the meaning of regulation. We've seen in the past few years that technology redefined each one of these aspects. Because of, ride sharing, autonomous vehicles, remote working, online marketing, which means that, you get your leads not by being in the most prominent location, but actually most of your tenants come through online channels and other channels. The fact that disruptors can leverage the crowd to undermine regulation and rules. If you look at what, for example, Airbnb has been doing, the hotel industry was assuming that since Airbnb is illegal, then it's not going to compete with them. But they've seen that Airbnb has so many users that depend on it and love it, both the people that lease space and the people that are guests, that governments in many cities basically succumbed or had to adjust regulation in ways that people couldn't imagine before. So technology is undermining all of these things, and that boils down to maybe the most important point. Excuse me for the long build-up.
That's very interesting.
Which basically means that real estate as a whole, even the most stable assets that people assumed previously that are valuable forever, just because they are where they are, so they have inherent value, these assets are becoming destabilized to the point where unless they're operated very intensively and very creatively and probably reinvented and readjusted constantly, they do not retain their value. And to cite an example, if you look at office buildings in central Manhattan, that until a few years ago, people assumed that they can just buy them and they'll have, a stable yield, and it's a very kind of boring business. Today, you're competing with people like WeWork, and the building becomes dependent on its operator. If you look at retail land, likewise, Airbnb suddenly come over, partner with a local developer, and start competing with your hotel and create new supply that is not zoned as a hotel even, sometimes basically serves your potential customers. So I think that's the ultimate impact of technology, really destabilizing what real estate means, which has immense implications to the institutional investors, which means immense implications for our own pensions and our own savings for the future, and what we can assume about the returns that we're going to see. So something to keep in mind.
Yeah, it's really interesting. I spoke to Amanda Haidt, who is president and CEO at STR, the hotel analytics company. And Amanda had an interesting insight about the impact of technology and Airbnb on the hotel industry. She actually thought that it had not been detrimental, and that in fact what it had done was it had increased people's propensity to actually go away from home and to experience living and working in other places. And as technology changes, the ability to actually travel and work somewhere else without any impact, right? You don't have to go to an office anymore. You can work from anywhere if you have a laptop and Wi-Fi. She was seeing a shift in the way that people live and work, and that Airbnb had stimulated that in some parts. So in fact, it was accretive to the hotel industry and not detrimental.
Well, she has a point, although it's probably more likely that Airbnb's rise coincided with an amazing rise in tourism, and as you said, changes to the nature of work. Changes to the nature of work. That meant that the whole hospitality sector as a whole is growing and benefiting. So Airbnb's pain is not felt as dramatically as it would have been felt before.
All right, that's interesting. Okay.
I think generally technology, we spoke about the low end and high end before in terms of funds and crowdfunding, but technology in many markets tends to have a polarizing effect. So, we have, let's say, YouTube, so everyone is a creator and can create content. But on the other hand, we have larger media companies that we ever had before. Everyone has access to information, but suddenly the data of our own lives is held in fewer hands than before. And we have companies that are so big and own so much data, again, like never before. So usually it's the middle that gets hurt. So the people above become bigger. If they could escape, a lot of them get destroyed, but those that survive become bigger. And then there's a layer at the bottom which has tons of smaller actors that can still survive and thrive. But it's very hard for them to make the jump from that bottom to the top.
Fascinating. Dror, let me ask you 3 wrap-up questions.
Sure.
What are the key daily habits that you have that make you and your business successful?
So I read every day. I read a lot, which I think contributes to everything I do, especially because my work in particular involves a lot of analysis. I like to travel a lot and, see a new place, definitely once a year, but even on a monthly basis to go to a new neighborhood or kind of see something that I haven't seen before. And the last thing, which is more of a general rule, I always like to question my assumptions. So I almost never take anything for granted, which sometimes means that it takes me much longer to understand things that other people just understand immediately. But through that process, I think I can sometimes come up with interesting perspective that can be valuable when driving investment.
Very nice. What has been the hardest lesson that you've learned in real estate?
I would say it helps to be lucky. That's the hardest lesson.
Right. All right.
I think the other one that I've learned is that it's better to stick to a big story or a big wave, like a big macro story, and usually that is more important than almost anything else in any detail. So I've seen that on the way up in China. We entered in the right time, and we had a decade, wonderful achievement, the best partners or the best timing in terms of the projects themselves. When the whole market goes up, you benefit almost no matter what. On the other hand, later when I had my own startup, which was more related to social media, when I started it, there was a lot of money thrown around, which I decided not to take because I wanted to get a higher valuation. And then a few months later, the whole kind of mobile app location-based craze subsided, and you basically couldn't get money no matter what, and no matter what, how strong your team was and how good your product was. And these days, my focus on real estate and technology, I see that on the way up again. So just by being in that space, I see so much interest, so many big players that are interested in doing things and exploring things. So big picture, more important than the details. I'd say that's a lesson, a positive one.
Very nice. Okay, my last question. If you could give one piece of advice to somebody who has not yet invested in real estate but is considering investing, what would that advice be?
I guess something very general again. Separate your own needs and likes from your investment considerations. People often, especially with their first investments in this space, they're very emotional about it. They kind of think of what they would have wanted, or if they would be, worst case, I can just live here on my own. Usually that's not the right way to look at it. I mean, really think of, why are you buying this? Who's going to live here? How much are they going to pay? Is it worthwhile for the average customer, your target customer? And together with that, I would also, another piece of advice is don't be afraid of the truth. I think a lot of, with their investment and are very reluctant to notice things or to listen to people with different opinions. So again, going back to testing your assumptions. So it's good to have assumptions, but be open-minded.
I mentioned the fix and flip market in the introduction today deliberately in order to contrast with Dror's high-level institutional perspective. There are a great many ways of investing in real estate, and having a good understanding of what the options are will give you a solid foundation for diversification and how to mitigate risk of getting caught in a downturn. If you want to succeed in real estate while reducing risk, sign up to the Crowdfund Real Estate News Digest that I distribute weekly so you can stay on top of the latest events. It's totally free, and you can find a subscription form at the National Real Estate Forum.org website, nreforum.org, right below the podcast player at the top. nreforum.org, right below the podcast player at the top. My next guest is a fellow with whom I've a lot of conversations about crowdfund real estate. Ian Ippolito is the founder of the Crowdfunding Real Estate Review and spends a lot of time looking at marketplaces and at deal flow. He's a fascinating guy who only came to real estate recently and who's managed to acquire a great deal of insight in a very short period of time. He's one of the most prolific investors and analysts in the industry, so please be sure to join me next time in that conversation. To be sure you don't miss it, you can subscribe to the series by going to the National Real Estate Forum.org website, nreforum.org, and hitting any of the links that I have included about halfway down the home page. Thanks for tuning in, and thank you also to Dror Poleg for sharing your time with me today. Until next time, this is Dr. Adam Gower signing off.